Good morning, everyone. I'm Vince Lancy. This is the Gold Fix Market Rundown. First, a big shout out to Jake for brokering, getting those two coins for me, the Dos Pesos, I should say, in Texas. They don't have a lot of those available up in New York. So now I'm a proud owner of Mexican gold money. Thank you, Jake. And I'll be showing the finished product of that tomorrow. Uh, we have several things to talk about. Pardon that pause. The first thing we're going to talk about is Goldman says central banks remain the anchor under gold prices, while under-owned investors and even tokenized gold sit quietly in upside optionality. And then we're going to talk about the story front and center there, MSA's story. Michael Oliver argues the long wait is over as gold, silver, and miners begin a structural leadership shift away from equities, broader equities, signaling that the bigger game, not the trigger game, in monetary metals is just beginning. I also want to add that I had a conversation with Eric Young, King Kong, fleshing out some ideas and some contradicting logic we're seeing in the market. And we both came to a conclusion and we agree, and I'll be sharing that with you as well after we do the main events. All right, so here's the markets. 10-year yields are up 3. The dollar's up 33. The S&P 500 is up 33. NASDAQ is up 176. The VIX is down 32. Gold is up 15 and change. Strong, but not crazy. Silver is up $2.17. Crazy and strong. 65.90. Actually pretty orderly when you think about it. 3.4%. But silver's not the killer last night. It's actually platinum. We'll get to that in a second. Copper up 4 cents. WTI up $1. Natural gas, unchanged bid. Bitcoin down 940, Ethereum down 38, Palladium up 23, Platinum up 64, up 3.9%. I'm sorry, up 73, up 3.9%. Gold, silver down 65. There were two structures that I looked at. One of them I think is the one that Michael Oliver looks at. I was looking at a big diagonal that we broke down below 90. That's when I got bullish silver. And now there's a sideways channel, a multi-decade channel that Michael looks at that we've broken. Probably, I'd say, on our charts, because he looks at it inverted, our charts below 72, I think. But now we're well below that. So the more impulsive moves in silver should be coming, as he also correctly notes. Okay. Let's move to the stories. The first story is Goldman Tether makes an impression and central bank buying broadens. Goldman argues gold's medium-term outlook is being anchored by structurally inelastic central bank demand rather than speculative flows. October purchases stayed elevated at roughly 49 tons despite futures volatility, reinforcing gold's role as a strategic reserve asset. Private investors remain underallocated, they contend, with ETFs still a small share of portfolios overall. There is an asymmetric upside, they contend, under Fed easing. And tokenized gold, including Tether gold, is growing but remains marginal, acting mainly as a substitute or cannibalizing ETFs a little bit rather than a new demand engine. They also hint at what would make it a new demand engine, and we flush it out in our version of the story when we break it down. You can read the full story in Goldman. Tether Gold makes an impression, and central bank buying broadens. All right, Michael Oliver put out a report on the weekend. The bigger game has just begun was our title for it. In his latest 360 weekend report, Michael Oliver identifies November as a decisive inflection point for monetary metals. Gold has broken multi-year relative resistance versus every major U.S. equity index, including the NASDAQ, which just happened, signaling a regime shift rather than a short-term trade. Silver has also broken out against gold. That's the channel that we talked about in the gold-silver ratio, historically a precursor to explosive upside phases. Mining equities, long discounted since 2008, another technical structure that he identifies, are now resolving decades-old valuation distortions and positioning to outperform both gold and the broader stock market. That breakdown, that chart, really something I would not have seen. It's really nice. There's a channel that we were in that we just, mining stocks broke below in 2008 and never recovered. Then we had this long, semi-long rounding bottom, well, 15 years rounding bottom. And now we just cracked out of the rounding bottom. So Michael argues that the market, having cracked out of the rounding bottom, should approach at least the bottom of that channel from before. It's actually a very insightful technical comment, and I subscribe to it. Anyway, you can read about those stories. You can read the full stories. Michael Oliver, The Bigger Game has just begun. All right, news and analysis. Before we get into the news analysis and the rest of the show, I had a conversation with Eric Young this morning or this evening, depending on your time zone, and we were going back and forth about the markets. So as I said, I had a conversation with Eric this morning or this evening, depending on your time zone, and we were going back and forth about the markets. A few things stood out. One is Eric has been saying for quite some time, whenever this market rallies, there are always people who try to talk it down by saying it's all speculation. And to be fair, in the past, there has been heavy speculation. But if you look at the data today, particularly open interest on the speculative side, both on COMEX and even in Shanghai, there really aren't a lot of longs out there compared to historic longs. Now, I can't speak to the Chinese CTAs directly, to be fair, but I can speak to the American CTAs. They are nowhere near as long silver as they have been in prior cycles, not even close. Now, it is true that we're seeing more buying at the ETF level. That's investor buying. What's different this time is how that ETF demand behaves. In the past, ETF buying was often tactical. It came in and then it came back out when the dollar strengthened or when traditional Keynesian indicators flipped. Look at the market. The dollar's up today, silver's up. Doesn't give a shit about the dollar. Nobody's paying attention to those indicators anymore, as we pointed out 3 years ago. What you're getting now is much more buy and hold behavior at the ETF level. And despite that, or maybe because of that, silver continues to grind higher, even with a clear lack of speculative participation, especially when there is a breakdown silver pricing to gold. Now, what is driving the market? Everyone's focusing on supply right now, I've noticed. No one's focusing on demand. Well, Eric and I focus on demand, at least right now. To put it very simply, Eric and I, in our conversation, he said, you have a liquidity problem, but it's not a money liquidity problem or a fiat liquidity problem. It's a metal liquidity problem. There isn't enough physical silver available. Does that mean there's no silver in the world? That there's absolutely a shortage? Maybe, maybe not. On the surface, it doesn't necessarily look like the world has completely run out of silver. It looks more like some of it is being hoarded. But when you step back and look at the facts, silver is getting harder and harder to obtain on the physical side, even without speculative demand. The point of liquidity is on the silver side. There's just not enough silver available. At the same time, you see tokenization ramping up in the US. You see Middle Eastern countries like Qatar and Saudi Arabia buying silver. You see India buying silver. You see China restricting silver exports. At that point, maybe we shouldn't be obsessing over the supply side. Maybe we should be looking at the demand side. Why is there suddenly so much demand for physical silver? Now, Eric and I have agreed on this when it came to gold before. We think new products are coming in silver as well, too. Don't know what they are yet, but it's consistent with the idea that we both approached of gold becoming an HQLA. It has to become a high quality liquid asset. That was my point. And Eric saying China's behavior is mirroring that of someone who's going to set up gold for repo. Well, HQLA and repo go hand in glove. So that's also consistent with what Judy Shelton has been saying, that you need metal collateral to counter the broader demise of financialization. The rise of tokenized gold and tokenized silver is key here, I think. Now, these products are going to make it possible for people without a lot of capital to own silver. When you combine that with the fact that physical metal is being hoarded and the fact that traditional silver owning demographic skews older, you start to see where this can go. Younger investors are much more likely to participate if silver is wrapped in a token. It's the new thing. Now, layer on what's happening in the Middle East, the buying side, across the BRICS countries. There's a clear desire to de-dollarize. The governments are encouraging citizens to own metal, and in many cases, to use that metal as collateral rather than selling it outright. The case of India, for example. You're looking at a world that wants silver, and for reasons they have not fully revealed themselves yet. We understand the supply's there, but why is there demand, and why is the supply not being made available? These reasons could be industrial. I've been studying things like the Samsung battery concept for years. I'm still waiting. Now, I'm not anti. Understand that I've been studying this since '94. The the solid state battery for silver. We have it in NASA. We had it on the moon. It's just not cost effective yet. That's going to happen. I just don't know when. I believe it will happen at some point. But these breakthroughs tend to appear, disappear, and reappear. We can talk about that some other time. Or the demand could come from new tokenized investment products out of the Middle East or India. I think that's what's coming. Frankly, after these conversations, I'm starting to wonder about some other things. For example, when JP Morgan moved silver from registered to eligible, which we reported on probably second, that looked like metal protection. Protection for what? I don't know. But that is how you behave if you want prices to rise, or if you are fearful of losing your collateral. At the same time, China wants more metal, India is buying more metal, and Saudi Arabia is taking delivery implicitly. So yes, on the supply side, there's probably plenty of metal in the world, and at some price you can get it. But the demand side has not yet revealed its true purpose. And that's where the liquidity thing comes in. I would not be surprised if we saw a spike into three figures before the market finally finds scrap supply. Now, that's Eric's opinion as well, but he's saying a spike is actually more possible than people think. Now, I know behaviorally how silver operates, as do other people. But what Eric is saying from what he's seeing on the tightness side and what I'm saying from historical behavior, they mesh. See, to get physical buying, you eventually need physical selling. That sounds obvious, right? But that selling will show up as scrap, recycled metal, heap leach silver, or byproduct silver. Once prices reaches a level that forces it out. They're not going to wait for that silver to come. The market will search for liquidity, and liquidity is physical selling. And the physical selling will be when someone who has scrap says, this is the price to sell, and they'll sell it. Investors, coin owners are selling right now. That's a trickle in that's creating 1,000-ounce bars for COMEX. But the scrap will hit the market hard. Where will it come out? I don't know. Maybe $70, maybe $143. That's my target. Maybe $150. I don't know. But it will come out. But the market, this is the key function of a good market. A good market will search for the selling. A good market, demand will find supply. It'll search it out like water seeking its way down cracks. That's what's going to happen here. And we could have a spike because of that. Now, I would not be surprised at all if this market goes into three digits. All right. My longer term target remains 143 over the next 5 years. But if that happens in the next 5 months, I'll giggle. Right. I mean, that's it. To put it bluntly, Eric and I came to the same conclusion on gold, that it would be used as collateral in repo after being designated as HQLA. And that has yet to be announced, but all the steps are being taken. Now we have to wonder, what is in store for silver? And if it is the people's gold, then maybe there will be an IPO of sorts so people can buy it in token form. That's it. That's the sum of my conversation. Now you know everything I do. Coming soon, we did all that, and we have why inflation will be going much higher. No data today. Chart. Action-packed today. We're going to do something I haven't done in a long time. H-Van, shout out to you. When we had nothing to talk about, I would talk about how algos operate in the morning. So I'm going to give you an algo operation, clear as day for me. Excuse me. Now, we all know about the slams. We all know that they're paper generated, but the buying is physical. Okay? Now, what is this? Call that what you want. I'm not going to get into that. We know what it is. I know what it is. I've testified in cases as to what it is. But this is called a market maker algo. A market maker algo says 6 bid for 1, 1,007. 6 bid for 1, 1,007. And it makes everyone hit the 6 bid. Right? And the 1,007, you can't trade 1,007. 1,007, it's in and out. It's a flash in and out. It's a spoof. And even when it's not a spoof, it's a spoof. No one's going to buy 1,000 ounces. It's going to intimidate people into selling. Now, every so often, so it just keeps buying on the way up. And then it loses control. Maybe it got turned off, or they lost control and the market starts to go up here. Now, up here, I'm not sure, but this is probably someone who's capping it, like a supranational entity, like the same market maker who's got a cap above, because maybe there really is real selling there. I don't care. But the market gets capped, and look how it returns to trend. See, people talk about technical analysis as telling you everything. It does. but I'm telling you what technical analysis tells you. And it tells you that this is a market maker algo accumulating. This is a market maker algo losing control and another algo capping it. And this is the market maker algo coming back. Now up here, why did it stop here? Well, maybe it was an order that got filled. I have 5,000 to buy. Maybe it's the guy who sold it here who's buying it down here. I have 5,000 to buy. Maybe it's a physical buyer who just wants to take delivery and he's going to take delivery off the exchange. Maybe it's a bullion banker short. Market maker algos don't have to be market makers. That's a market maker algo is created by market makers like me. It's how you, I used to use a market maker algo, but I wasn't using it for this purpose. And if you're big enough, if you have enough money, you can use it to spoof a market on short-term behavior. So this is where I lived and breathed. This part up here is the part you have to be worried about. So the market maker algo operates and accumulates. Buy one, buy one, buy one, buy one. Sold 1,000. No one buys 1,000. Buy one, right? So you just flash it in and out. You flash it in and out. People went to jail for that. People go to jail for that. If that's what they're doing, I'm not saying they are, but that's how you do it. Then it gets up here. Why did it get up here again? Just to come back to that, it got up here because the algo, you're going to laugh at this, but I'll tell you. The algo either got turned off, meaning the order's filled, I don't care, click, okay? Or the algo finished and they did a VWAP. If you know what a VWAP is, you understand what I'm saying. A VWAP makes the fill look even better. And now the market's here. So is this another algo? It could be, I don't know. But the point is, when a big player needs to fill a big order in a market that isn't continuously liquid, silver is not continuously liquid. When there's a sell-off, whether it's orchestrated or not by some evil player, the algo turns on. Click like that. I used to do it on the floor. I have 1,000 there. I'll buy one. I have 1,000 there. Buy one, and no one would take me on. Well, when they did, I would cry. No, I honor the trades. So anyway, this is how it works. Okay, so this is an order being filled. Is that order filled forever? No, it could be buy me 5,000 a day for the next 50 days. It could be a buy 5,000 at your discretion. It could be buy 5,000 in the next hour. These are very deep-pocketed buyers who are very patient. This is institutional demand buying it at 63.50. Does that sound bearish to you? This isn't speculative demand. Remember, when silver gets spoofed lower, it goes sideways and then lower and sideways and then lower. Someone is catching the falling knives before they even gain any speed now. So that's the market. Have a great day.